The engagement letter is sort of like a unilateral contract. And that it's, you know, basically you're going to do this contract and you have your responsibilities, you have their responsibilities, and as long as everybody meets their responsibilities, then it's a contract. Okay. A few things we get right off the bat are, you know, what we're going to do most times just an audit. The auditor goes into their responsibilities, but they also go into, oftentimes they'll go into the things that we've talked about before. About materiality and reasonable assurance that we, you know, it's not 100% assurance, but you're only looking for things that are material. Sometimes people think that the audit is going to look at everything. It doesn't. It only looks at those things that will affect the impact the income statement, or the financial statements. Well, the income statement included, but anyway, so you try to let them know exactly what it is. And then also there's limitations on internal control, which, by the way, are management's responsibility, but it also affects the auditors in that they, because if they rely on it, there's inherent limitations to it, which we will talk about. Not today. We'll see what. Okay, management's responsibilities. Management has to give us all the information. Responsibility for financial statements, they're responsible for the internal controls, and they're going to provide the auditor with access to all relevant information. So those are things that we are responsible for our part, they're responsible for their part. If they don't fulfill their part, then it's not going to be a successful audit. Documentation retention. The AICPA requires 5 years. The PCAOB requires 7 years. So if it is a non-issuer, you have to keep you're required to keep the work papers for 5 years. If it is a publicly traded company, you're required to keep it for 7 years. That came about because of Sarbanes-Oxley. One of their audit firm was Arthur Andersen, and what Arthur Andersen did infamously was before they were charged with anything, they destroyed all their working papers. They were trying to get a gross misconduct rather than a fraud conviction, and it worked actually. But now the new requirements are that you must retain those papers for the AICPA requires 5 years, but PCAOB, if it's a publicly traded company, you have to keep the work papers for 7 years. Okay, this one is looks kind of funny, but it the financial statements agreement with other management documents. There's probably a comma there, I think. I left a comma out. And a company annual report, that the financial statements that you sign off on, those need to be the same ones that they present to the public, basically. That there has to be an agreement between what you tell people. If your revenues were 341 million, that's what you have to tell people. Our revenues were 341 million. You can't say our revenues were 380 million when the financial statements clearly say it's 341. So that's what they're kind of saying, is that, look, the other information that you give to the public needs to be in agreement with the financial statements that we audited. Timetable, estimate of fees, blah, blah, blah. Okay, staffing. Some of this is kind of assess need for specialists. Specialists include One thing I was bring up is gemologist. Can also be for pensions. Pensions is probably much more common than gemologist, but gemologist is the one they talk about a lot. A gemologist is, say you're auditing a store that sells jewelry. You know, if I look at a diamond, a 1 carat diamond might be worth, I don't know, $1,000, or it might be worth 20,000, depending on, you know, what the clarity and all this kind of stuff. So, you know, you may not, as an auditor, we're generally not trained to value diamonds, but we can bring somebody in who has that training and use that specialist to do it. More commonly, things like pensions. Pensions are very complex. You have to use actuaries and all that kind of stuff. And so a lot of times you will bring in those people as specialists to look at the pension plans. Some of the pension plans are, you know, when I worked at Navistar, our pension plan was bigger than our company. It had more assets than our company had. So plans are really big. Need for IT people, that's pretty much every audit. Use of internal auditors. When I was an internal auditor, I was used by the external auditors quite a bit. We did a lot of stuff with them. It might sound kind of funny, but a lot of times they will use the internal auditor to help with the audit, but also they'll also they'll look at their reports and things that they have, because the internal auditors are better, they know more about the company because they're you know, all year round. And second of all, that they have a lot more time. You know, it was very common for us to have, we went into an audit of, say, an assembly plant, we might take 4 or 5 weeks to do the inventory. Whereas external auditors come in, they may have, you know, 4 or 5 days to do the inventory for the entire company. So we you know, our reports are much more detailed usually than they are. Now, some of that they don't need, but so a lot of times they'll look at our work certainly and say, oh, you know, see what the problems are, see where the problems aren't, that sort of thing. But they'll also have us do work for them, and there's nothing wrong with the internal auditors doing testing and things like that, but the judgment calls are all the external auditors. So if I did testing on something, you know, I can go through the test and I have it documented, they can go through and look at it and all that. But I didn't make a conclusion on whatever the testing was, good or bad. They make that conclusion, not me. I simply do the testing. You know, I go through and do testing. And part of the reason why you use those people is that it's a lot cheaper. That you know, they bill out quite a bit for it. And these are just some of the things you look for in internal auditors. Are they objective, competent? Do they have quality control? Time budget, interim audit work and year-end audit work. Okay, one of the things that is commonly done on an interim basis is inventory. Many companies do not do an annual inventory. They will do an inventory periodically throughout the year, and generally they'll do the entire inventory, will be audited at least once a year, but they'll do it on a test basis of any, you know, certain areas. So if you ever go into like a late night, like a Walmart or something like that, one that's open 24 hours, if you go in there like, you know, 11 o'clock, midnight or something like that, a lot of times you'll see people actually taking inventory. They'll have an aisle marked off and they'll have these tags on it, and they'll be doing an inventory. Maybe it's office supplies. They'll go down and do that office supplies inventory, and that will be the once a year inventory of office supplies, even though it may be done in March, you know, March 14th at 2 in the morning, but they do it at interim dates. As an auditor, you will go and watch their procedures and that for them doing these inventories at these different locations. But they generally do it, they don't do it all at once. There might be some things they do, but most of the stuff they do throughout the year. So when you're doing an auditing, in audit, you have to do those, you're doing stuff interim, even though you're doing the audit report for December 31st, you might be out there in March watching them do inventories because they're doing it in cycles. Now, that's okay if they have good internal controls. Most of your large companies will. So something like Walmart, I'm sure they have great internal controls comparatively anyways. And so, you can rely on the internal controls. If you can't rely on the internal controls, you can still demand that a year-end inventory be done. Year-end inventory is usually better evidence, but a lot of times it is, well, in the case of Walmart, it'd be impossible, but a lot of times it's not nearly as convenient to do it that way. So if you do find though that there's a problem with internal controls, you cannot rely on the inventory counts during the year, you can insist on year-end inventory. Okay, so year-end inventory is better, although it, well, and a couple of things, a lot of times getting that kind of time at the end of the year is a little more difficult too. So interim work. Interim work is allowed if the client has strong internal controls. So if they have strong internal controls, there's no problem. Year-end inventory work. Is better evidence it may be required if internal controls are weak. I should stop here for a second. You might be wondering, well, okay, if year-end inventory is better evidence, why don't we just require it for everything? Which is a reasonable thing to think. We don't always get the best evidence for a couple of reasons, but the first one being is that a lot of times the best evidence is more expensive. And if you can get just as comfortable with the numbers using less expensive evidence, that's probably a good thing to do. So from not only from your point of view as saving money, but also from saving the client's money. So a lot of times, we don't always get the best evidence. A lot of times the best evidence is too expensive. But we do have to get enough evidence that we can make a opinion on it. Okay. So here we have a first year consideration. Here's an income statement. We have our sales. We have our cost of goods sold. Gross margin and so on. Okay, at year end, which of these numbers would be very difficult to find, to be able to prove at year end? I'll give you a clue. It's in here. Which one of those numbers in red would be the most difficult to get evidence on at year end? Anyone?
End of inventory?
The beginning inventory. Yeah. Well, because this one we can get at the year end. So at the year end we can count the inventory, but this is the one that's the problem. Because we can't jump in the time machine and go back to the beginning inventory. Now, notice something though, if you don't know this beginning inventory, if this is unknown, notice we don't know this good's available. We don't know, well, we know the ending inventory, but we don't know the cost of goods sold. So this cost of goods sold would also be we'll zoom in a little bit here. We wouldn't know this, which means we wouldn't know this. Yeah, we wouldn't know this. So if they've never had an audit before, the beginning inventory can be a problem. Now, if they had an inventory, if they had an audit before, that's fine. So, another CPA firm came in and did the audit before, you can use their number, that beginning inventory will be the ending inventory from the last year. So you can use that as a beginning inventory. So there's not a problem if they've already had an audit. It's when they don't have an audit. Now, one thing you can tell the client is, look, if you're planning on having an audit, what you can do is have us come in and just do the inventory. If we can get an inventory number, then the next year everything's fine. Excuse me. My allergies are killing me. Excuse me. All right. Anyway, so anyway, the beginning inventory. So that's the problem. Now, again, if this is only for if they've never had an audit before. So knowing this, you may have to tell them, look, we can't give you a clean audit report the first year. Excuse me. So what type of an opinion would you tell them that you can give them? What opinion is appropriate if a material account balance cannot be verified?
The disclaimer.
Disclaimer is probably the most appropriate one. You may also give this one. Disclaimer is the best answer to this, though, what you just said. Although the other one would be available. Depending on, it probably wouldn't be available in this case because not only does this affect the balance sheet stuff, it also affects the income statement stuff. It's going to affect other things like the statement of cash flow and stuff because it's income. But yeah, so it's possible. Now, there is something else we can do. There are basically 4 financial statements that you write your opinion on. The income statement, statement of retained earnings, or sometimes statement of equity, balance sheet, and then statement of cash flows. Now, the balance sheet stuff is all done at year end. So the balance sheet is all as of 12/31. It's all at the year end. So a lot of times you can give a clean audit report on the balance sheet and a disclaimer on the other financial statements because they're all linked together. So the rules are that you must give an opinion based on the financial statements as a whole. but that has come to be interpreted as you can actually give separate opinions on separate financial statements. So we can give a disclaimer on income statement, statement of retained earnings, cash flows. Those are all have net income in them. And give a clean audit report on the balance sheet. You say, well, why would you do that? Well, we do that because remember, you're trying to help your client. I mean, I shouldn't say help, but you're trying to give them the best bang for their buck, right? So at least they can go to the bank and say, yeah, the income, these are disclaimers, but our balance sheet, our cash, accounts receivable, our inventory, our assets, all that is okay. So the balance sheet's okay. Now, again, it's some comfort to whoever's, they're showing these to. So what you can do is you can give a disclaimer and then give an unmodified on the balance sheet. So the balance sheet could have an unmodified report, whereas the other ones are, I'll get disclaimers. So you can split up an opinion. And again, you're doing this to give the client the something, right, that they can actually take the money and say, look, while these other financial statements are, they can't be relied upon, the balance sheet can't be. So you're giving them something rather than just giving a disclaimer for the whole thing. Now it is up to the auditor though. You can give a disclaimer on the whole thing. Saying, look, for whatever reason, I don't want to split up the opinion that this whole thing is a disclaimer. That's still up to the auditor. But one thing you can do to help out the client is to, again, truthfully, give them an unmodified report on the balance sheet and a disclaimer on the other ones. Okay. All right, audit plan. Excuse me. The audit plan. The audit plan is a specific plan that has specifically the steps that you are going to do, or you plan on doing anyways, to get enough evidence to give an opinion. It's very detailed, what the tests are going to be for different accounts. They probably have times in there that, allotted to each one of them, unless a problem comes up. But they're very detailed. And by the way, when I was doing auditing, I found a lot of things that got reported. It's not that it's not that I was such a genius. It's in the audit plan. If you follow the audit plan, you find a lot of stuff. The audit plan is there designed to find problems, right? So if you follow the steps in it, it's kind of funny, like on the CPA exam, they'll say, what's the test for this? What's the test for that? And all that. But in reality, when you're actually doing an audit, you're going to learn auditing from somebody. They're probably going to have audits from previous years. Certainly, if you're in a CPA firm, they will. And you'll follow basically those audit plans. They might tweak them a little bit from year to year. They always do. But for the most part, you're going to follow those procedures. And if you follow those procedures, you find stuff, or you will find stuff if it's there. So, it isn't like in auditing, you have to be this genius that just knows everything about everything. You don't. The audit program, the audit plan is going to be very detailed, and it'll tell you what you need to do. Now, even though you plan it that way, there's always something happens every year. Something happens. Some new machining comes in. Some new equipment's coming. There's a new merger. There's a whatever. There's always something happening almost. But you might have to tweak it a little bit. But generally speaking, they look like now. No two companies are the same. So are all the audit plans going to be the same? No, right? I mean, so because all companies are different. There's no two companies that are the same. So all the audit plans are going to be different. And the audit plans can change during the audit. There might be a place that, some area that was a problem last year. You start going into this year and it's not a problem at all. It's perfect. Whereas something else might crop up. Oh, this is a problem. Maybe you plan on spending whatever 6 hours on this, but it's a complete mess. So you may end up spending 2 days on it. So always the things it's a flexible document, and it's one of those things that it can change depending on what you find. But generally speaking, though, if you follow the steps in it, you find stuff. You don't have to be, again, this genius that knows everything about all the accounts and how to test them and all that. They give a very high level description, very detail oriented. Risk assessment procedures, which we'll talk about in a minute. You assess risks. You will design audit procedures for each class of transactions. I should maybe expand this a little bit. Well, I'll do it later. I think I have it down here somewhere. And then there's a few other things that we do, which we'll talk about later on. But the bulk of the audit's going to be, well, you do the risk assessment at the beginning, and then the bulk of the audit's going to be here. This is most of the. So a tentative audit plan is developed based on the auditor's initial risk assessments. The plan may require frequent modification as the auditor. Okay. So the audit plan has which of the following characteristics? Which letters will correspond? Anyone? Oh, come on, someone take a guess. I'll do the first one.
B. Oh,
Yeah, no, you're right. Okay.
okay.
You did the first one. Well, yeah, let's cross these out as we go by. So it's not general in nature, it's very specific. And can it be changed? It can be changed and virtually always is. It's based on risk assessments. We haven't done that yet, but it is.
Is F one of them?
Yep. Yeah, and it's not the same for all clients. Humorously, way back in the 70s, way back when, they used to have like a big list of, for auditing cash, you do these 27 steps. For auditing, they kind of realize that, okay, look, this isn't really appropriate. This is it's trying to make it fit everybody, one size fits all, and it's not really done that way. Okay, assessing audit risk. This, getting an understanding of the client and its business environment. This is required. You must understand the client's business or you cannot do the audit. You won't know where the risks are. And you'll get an understanding of the client, both from the client's specific business, but you also might get it from their industry, whatever their industry is. For instance, if you're auditing somebody that's in the auto industry, Ford, Okay, you have to know what the auto industry is going through. You also have to know what Ford is going through and how they're, in that industry, how they're adapting or whatever they're doing, all that kind of stuff. You can't do an audit of them unless you know where the problems might be. What are the risks that they're doing? So that is, it's very important to get an understanding of the client, because if you don't, won't know what can go wrong. Okay, that's one thing that sometimes people think is kind of funny, but a lot of times just talking to management and others. Talking to management people, talking to people on the floor. Sometimes talking to people on the floor, management, not that they purposely mislead you, but a lot of times they'll have, kind of the management line. Oh, okay, we do this, this, and this, we're all about whatever. We're all about safety or whatever. You go on a line, it might be completely different. So there's nothing wrong with talking to anybody and everybody, just to kind of get a feel for the company and how they're doing, what they're doing, how the shipping's going and all that kind of stuff. Observation and inspection. I have found in my auditing that observation is probably the best. It's more difficult to do because it's hard to watch somebody and not make them nervous or or feel creepy doing it. But a lot of times if you're just talking with them, and as you're talking with them, seeing how they do something, a lot of times, I can't tell you how many times that I've been given a procedure. Oh, this is how we do this. You go, okay, and then you go observe, and it's completely different. The what's in the management manual or what they've given you that this is how it's done is not anything like they're doing it. Observation is much more convincing than inquiry. Asking management how something's done, and then observing it, it's more persuasive what you observe, what they're actually doing, rather than what somebody's telling you. And it might not be that they're being bad. Sometimes they don't know that it's not done that way. I mean, I've definitely had, come back and said, look, this is like, they're doing it like this, and really, huh? Wasn't done like that when I was there. And then you get into those kind of conversations where they honestly just didn't know. They thought it was done the same way that they did it 5 years ago or something. Talking to people outside the company. Legal counsel, evaluation experts, if they had mergers or something especially. And reviewing information from external sources. Analysts, banks, rating organizations, that sort of thing. So looking at things from the outside. So you try to get an understanding of the client and their environment. Okay, analytical procedures. A few things about analytical procedures. The general term for it is that you analyze relationships between data. It could be financial or non-financial. So not everything we analyze is financial. Now, one of the things we do look at is ratios, usually like current ratio, quick ratio. That's the second one on that list. But it could be other things too. There could be number of labor hours used to produce a car or something like that compared to the industry's labor hours to produce a car. There are things that are non-financial. Labor hours are not financial. It's more of a management kind of efficiency thing. So you will also look at those things that are non-financial, and they will give some kind of relationship between what you're trying to do with the company, do the audit and analyzing the risks, and what you need to look at. Now, a lot of it is financial, but it doesn't have to be financial. It could be other, like say labor hours, it could be other things, units shipped, all that kind of stuff. Ratios are very common to use as analytical procedures. So these are all analytical procedures and plausible relationships, which I'll talk about momentarily. All right, so these are all go with the analytical procedures. I don't know why I'm doing this. Yeah, so analytical procedures, analyze relationships. Oftentimes they're ratios and they have plausible relationships. Analytical procedures look for unusual things that, when we talk about plausible relationships, there's relationships that you would expect happen, right? That there's relationships that you would think would go together. For instance, more sales, you'd probably say, okay, well, that would mean more cash coming in, right? That would be a plausible relationship. The more sales they have, the more cash that's going to come into the company. You know, that's plausible. That's what you'd think. So, you know, you get these relationships. Most fraud is found through analytical procedures, because you'll say, okay, there's an increase in sales, but wait a minute, how come cash is less? Well, it's less because those sales are fictitious. That's why it's less. You know, so, you know, there are these analytical procedures are kind of based on plausible relationships, relationships you'd expect. They aren't absolutely proof in themselves that there's a problem, but they kind of show you where to look. Okay, so here's an example. We have sales and we have advertising expenses. And what is unusual about those two?
Did they increase in advertising expenses?
Yeah, well, you notice
Q1?
it went from 2021, they had sales of 19 million, almost 20 million. And they go up. The sales went up to, you know, the sales went from 19 up to 19 million up to 22 million. Okay. Well, what would you expect to happen to the advertising expenses? It would be reasonable to expect that the advertising expenses would increase as well. Right? I mean, how do you get more sales? Okay, well, you might pay more commissions, you might advertise more. So this would be a plausible relationship would be, okay, if sales increase by whatever, 10%, then the advertising expense would increase by some amount. Whereas in this case, you have an advertising expense going down. Now, is this absolute proof of fraud?
No.
No,
No, it might be, maybe they're more efficient. They may have found a better way to advertise. They may find, you know, there's all kinds of reasons why this may be okay. But as an auditor, you say, okay, wait, we got to look into this. You know, and what's the danger here? Well, the danger is could be with either one of these two, right? I say, so what risk might be investigated? It could be that the sales are overstated. That's nice about sales. Or ad expense is understated. I don't know. So these are the two kind of things you might take away from, let me change the color. So these are the two things you might come away with saying, okay, we got to look at this because, either these sales might be overstated, or it could be that the advertising expense is understated. So again, we're looking for plausible relationships, basically, is what you really want to look for. And again, and this is where, like I say, 90% of fraud is found. In fact, so much fraud is found through analytical procedures that they are required. Analytical procedures are required because they will point you, they aren't necessarily proof themselves of fraud. Usually they're not, but they will tell you where to look, like, hey, that's kind of unusual. That's an unusual relationship. That's not what I expected. So these are required. So analytical procedures are required because they are very effective. Okay, so again, you're looking for plausible relationships. Okay, risk analysis. Risk analysis has two parts to it. Dollar amount and the probability that of the risk occurring. Yeah. So coming down here, we have these dollar amounts. So these are the risks, dollar-wise. And then underneath here, we have the probabilities. So which risk is of the greatest concern? So we are going to multiply those out. So the expected risk. So $5 million times 0.01. At 50,000? You should know this.
Is it B?
50,000.
Yeah, so this would be 50. Wait, this one would be 50,000. Oops. B is what? 160?
Yes.
C is 4, right? Yeah, so the one that's going to be your biggest concern is going to be this one. because it is, the expected risk is the highest. And even though you say, well, wait a minute, that's $5 million. Yeah, but there's only 1% chance. It's very likely this is not going to happen. Whereas this is much more likely that it will happen. So, this is kind of the more important one for two reasons. It's more likely it's going to happen, and it's a larger dollar amount. Now, this one over here, you say, well, wait a minute, that one's very likely to happen. Yeah, but it's such a small amount, so you're always looking at the dollar amount, but also the probability. And something that's remote, you generally don't worry too much about that. 1 in 100. Do 1 in 100 things happen? Yeah. We got COVID, 100 years of not having a, terrible pandemic, and then we have a terrible pandemic. It's one, it doesn't happen. Yeah, it's just very unlikely, between the, 1919 flu and the 2020, 100 years, people were born and died and never experienced either one of those. So, things that are very unlikely, you generally don't worry too much about those. Things that are more reasonably likely and that have a higher dollar amount, those are the kind of ones you're going to go. So, so this would be risk B. I'm going to stop here. We'll do materiality next time. I want to get to the I want to get to the probability. It's called monetary unit sampling. Sorry, it's called probability proportional to size. That's another term for it. But monetary unit sampling, I want to go through that. So I think we'll stop there with the materiality. We'll pick that up next week. This is a kind of a big chapter. This chapter 6. It's a lot. There's a lot in it. So anyway, so let's go ahead and take a break. Come back at like 7, and then we'll do some of the monetary unit sampling. Okay, let's see here. Oh, not too much there. I think this might be page 4. Okay, I'm gonna go back to the first page of the monetary unit sampling, because I wanna make a point about just sampling in general. And when you're doing sampling, if you don't take 100%, there's always the possibility that something could be wrong, even if it's very remote. There's a possibility that unless you do 100%, there's a possibility that something might go wrong. And monetary unit sampling is exactly the same way. So what we come up with is something that looks like this. Something stupid here. Not that that's so surprising, but so it's sort of like this. Okay. All right, so you have some some projected value you come up with, just like we came up with for classical sampling and like we did for here. We had this projected value of this. Projected misstatement of that, let me say it. So we also have this projected value. And this is our best estimate as far as what it is misstated by. All right, now there is because this is a sample, there's kind of like a bell curve over this, that even though we came up with this as our best answer, it might be, a little bit, you could go, either way. I didn't draw this very well, but it could go, this might not be exactly right. If there's there's a possibility it could be a little bit this way or a little bit this way. Now, if it's monetary unit sampling, it's only made for overstatements. So this isn't possible. But it could go further down this way. Right? It could be a little bit more down this way. So for instance, on the first page, we had that this is 4,100 was our projected, they said it was 5,000. But it could be a little worse than that. We didn't sample everything. So it could be a little bit worse than that. And this is what we're going to talk about now. And what could go into this? It could be just that it's a sample. And it could also be that there are misstatements. What I'm saying is, that just a sample in itself can be off by some amount. But the more misstatements you have, the more likely it's going to be that it's misstated, right? So there's actually two things going on here. Even if you didn't find any errors, there's still a possibility that it could be off by something. It's a sample. But the more errors you have, the more likely it's going to be misstated even more. And that is taken into account in probably proportional size, and that the more errors you have, the greater that, that estimate of how bad can it get increases because of it. And notice that when you do the, keep doing this, I keep clicking. When you are, doing your, getting your evidence, you're always going to pay attention to this, what they call upper limit. We'll talk more about that. But this kind of upper limit that, maybe 4,100 is our best estimate, but to be, 5% sure, it could go down to, say, 3,800. This is what we would use for our audit. This is what we would determine whether it's material or not. I just made those numbers up. That's not in the problem itself. Okay. So even though this is our best estimate, oops. Sorry. So this is our best estimate. It's possible that it could be worse off. And that's what this second, this kind of third step here we're going to look at. Okay, so this is on page 4, I believe. All right, there are some rules. Or monetary sampling, monetary unit sampling. Incremental allowance, that's what we're going to get into here. It's incurred when there are misstatements are detected in the sample items. In other words, sampling error increases when more misstatements are detected. It is only used when the value of the misstated item is less than the interval. Okay. Overstatements. Are the only thing we're looking for. Understatements are ignored. So it's kind of like fishing. We're only looking for overstatements. If we find an understatement, that's not what we're fishing for. If we find an understatement, we ignore it. We say everything's fine. So if it's an overstatement, that's what we're looking for. If it's an understatement, we're not looking for understatements. This method does not address understatements, period. So we ignore it. It's kind of like you go fishing and you still, you're trying to catch fish and you pull in a boot. It's not what you're looking for. So you throw it back. Well, you don't throw it back in, probably throw it in the garbage. But point being is that you're not looking for boots. You are trying to get fish. So same thing here. We're looking for overstatements. We find an understatement, we don't do anything with it. Now, there's also a part of this that is really kind of, you got to kind of think about a little bit. If the misstated item has a book value that is equal to or larger than the interval. So in other words, we're talking about things that are 100% going to get picked because they are bigger than the interval. Whatever the interval is, they're bigger. Then the misstatement is the difference between the book value and the audit value. And these are not included in the incremental allowance. And I'll explain why in a second. Okay, so what we're going to do is we're going to do some of these. The spacing here is a little funny. It's even funnier. So here we have a book value of that. And we found some of these errors. So these are the ones that are error. And by the way, a lot of times when you're taking the CPA exam, especially, they're only going to show you the errors usually, because there might be 100 things, and that you only interest in those ones that are off. I gotta sneeze. Excuse me. Okay, so we're gonna go. Now this first one is kind of the normal one that we're used to doing. Just so you kind of recall that we take the audit amount divided by the book value, and we times it by the interval, and that'll give us a projected value. But we're more interested in the projected misstatement. But let's go ahead and do this. So 14, move the document cam here. So 14 divided by 20. You pay $2 for a calculator. Okay, so 14,000, 20,000, 40,000. Okay, so the projected value is 28,000. So this is a normal, misstatement that we had. Projected misstatement is 12,000. And notice that this is an overstatement. Right? The audit value is 14,000, they're saying it's 20,000, so this is an overstatement.
Question, where did we get the 12,000?
The 40,000 minus the 28. So,
Oh, I see.
yeah, so that interval is, here, let me put this in there. So the interval is 40,000. So if we're saying that interval really is like worth 28, then the misstatement's gonna be that. And this is included in the incremental allowance. This is what normally you would be looking for. This is an overstatement. Notice it's less than the interval. And it's going to be including the incremental allowance. And again, we'll see how we actually work that out later on. Okay, let's go on to the next one. Next one's pretty straightforward too, like 2,400, 3,000. This is an overstatement, so. I'm gonna copy this up here just because spacing. Ah. Okay, this is 32. This is 8, I think. And again, this is with incremental allowance. This one can kind of throw people a little bit. But notice that it really is just another overstatement, right? They say that we're 1,700, we say it's worth 0. You know, we're saying it's 0, they're saying it's 1,700. 0 times anything is 0. Okay, so these first 3 are kind of straightforward, run-of-the-mill, normal, like we've been doing before, kind of things. Something is different on number 4. What is it? What's different on number 4 than on 1, 2, and 3?
The amount is higher than the interval.
This is an understatement.
Did you say interval?
No,
Oh, I'm sorry. The audit value is 2,600 and the book value is, so this is an understatement,
Because the book value is less than the audit value.
higher.
Oh, higher. Yeah, okay.
Yeah, so, oops. So it's kind of like this. This is, it's higher than that. So we ignore this. So the projected value would be 40,000. Oops. Misstatement would be 0. And it would not be included because it's not misstated according to this method. So if the book value, excuse me, if the audit value is higher than the book value, it's an understatement, we ignore it. If this method is not meant to find those, and when it does, we just ignore it. So again, that's one of those things that's kind of strange. If we're, as an auditor, whenever you come across something that's wrong, you go, hey, this is wrong. You don't say it just like that, but you know what I mean? And so, you see that you find this one that has an error in it, and because it is an understatement, using this method, you don't do anything with it. It's not supposed to catch those, and if we do catch it, we throw it back. So it is not meant to catch understatements, and it completely ignores them when it does catch it. Just acts as if it's a, not a problem. Okay. Down here, this one is the tricky ones. And it's tricky because of this. The book value, this is the book value. I'm going to give a little more room here. So this is the book value, and this is the interval. I gotta redo this one. So here's the book. And here's the interval. So notice the book value is higher than the interval. This is one of those ones that we talked about a little bit, that it's guaranteed to get picked, right? If the book amount is bigger than the interval, you're guaranteed that you are going to pick this item. It's 100% guaranteed. But now notice something that's happening here. This interval is really based on the book values. And this is the book value. In sampling, we take a small amount and project it over the larger population, right? Take a few items, project it over the entire population. In this one, you'll notice it's doing just the opposite. This is taking something that has a book value of 44,000, and if we go through our regular process, it'll be scrunching it down to a $40,000 interval. It'll be reducing the actual error. So I tell you what, let's go ahead and work it out like we normally would, and then I'll kind of show you why it's wrong to do it that way. Okay, so here I'm going to show you the wrong way first. What did you learn in class today? Well, we learned how to do it the wrong way. Why do you teach you that? Oh, he's a knucklehead. All right, so if we were to do this normally, we'd say, okay, we'll take this. Oops, divided by 44,000. Times the interval. And, ooh, that's not right. Okay, so 11,000 divided by 44,000, I think is 25%, right? So this comes out to, oops. It's going to 10,000, I think. And so the misstatement would be 30. So this is wrong, what I'm showing you here. This is the wrong way. Oh, wow, that's weird looking. I'll leave it like that, just so we really know it's wrong. If you look at this item, okay, so here's the audit amount. If you compare the audit to the book amount, how much is what is this thing actually off by? What's the actual misstatement? What is it actually misstated by, this item, number 5? You go out, you audit it, you say it's worth 11,000. Your company says it's worth 44,000. What's the actual misstatement on this thing? Oh, take a guess. What is this actually misstated by?
33,000.
Yep. Yeah, so here, I'll show you here. 33. You know, it's, they're saying it's 44,000. We're saying it's 11,000. Ooh, got too much in there. Hold on. So notice if you look up here, you know, this is the actual misstatement is 33,000. It actually, this up here reduces the misstatement. Why? Because it's projecting it over a $40,000 interval when the item is actually bigger than the interval. So when the book value is bigger than the interval, you take the actual loss, their actual misstatement. Oops. So we don't do it this way. Why? Because we know this thing is misstated by 33,000. It's not misstated by 30, it's misstated by more than that. So its actual is 33,000. So whenever the audit, sketch that, the book value is larger than the interval, we take the actual misstatement, which is the difference between those. So we'll get it one down here too. This is not included with the incremental allowance. And I'll explain that too. The incremental allowance is there because there could be something else in the interval that is misstated, right? If we come up here, you know, the book value is less than the interval. There's other things obviously in that interval. Excuse me. Same thing here. There's other things in this interval. You know, we got 3,000 of it. There's another, what, 37,000 of it. And same thing here. We got 1,700 of it, and there's another, whatever it is, 38,300 in there. So there's other things in these intervals that could go wrong. And that's what leads to the incremental allowance. There could be, there's more things that could be wrong. Notice down here, nothing else could go wrong. This thing covers the entire interval. So nothing else could go wrong down here. The entire interval is taken up by this loss. Now the misstatement is 33,000. You know, we just take the actual amount, but it you know, the entire amount is going to be the misstatement. Okay, and we're gonna do the same thing down. I tell you what, let me be quiet and see if you can figure out this one down here. And again, you'll notice that the book value is more than, in fact, this one would cover 2 intervals. Right? Yeah, at least 2. It might cover 3. Okay, so here we will have our projected misstatement will be adding all these up. So 12 plus 8. Mr. Calculator. $118. You may want to check that to make sure.
I got the number.
Okay, so 118. So this is the projected misstatement. So the best estimate of the accounts receivable is what, 800,000.
I don't know if I missed something, but it's a projected misstatement. I got 86,000. So the 12,000, 8,000, 8,000, then 33,000, and then
The third one's 40,000.
oh my God, I missed that one.
Okay.
Thank you.
So, wait here. So this would be, $800,000 minus the misstatement of 118. And on this one, you really don't have to know whether it's overstatement or understatement, because it's always for overstatements. There isn't there's no possibility that it's, was it 682 maybe? I think that's it.
Yes, it is.
So this would be our estimate of the accounts receivable. And this would be our best estimate of it, what it would be. So this is actually the best estimate. It might be off by more than that, but this is the best estimate as far as what we think it could be. Okay. I think we're going to do part of this one and then we'll come back. We're just going to do this top part here. And I think I'll be quiet and see if you can do these first 3 items. Find a projected value, correct misstatements, and we can talk about whether it's going to be in the incremental or not. So all we're going to do is these ones here, and we'll get this one, predicted misstatement. We can get that. And then we'll leave the rest, and we'll stop before we go to the rest of this stuff. So let's see if you can figure out these first 3 items that we found. All right, what did I do wrong? Did something horribly wrong.
That's an understatement.
Yep. This should not be done because this is an understatement. Shouldn't be spelled like that either. This is not a problem. If we were to, there's not a problem with this one at all. Oops, oops, oops. There is no misstatement on this one. And again, this kind of, it kind of goes against our grain as auditors that do that. You find this error and you go, well, so you got to do something with that, right? No, you don't. Not with this method. If it's an understatement, you ignore it. So there actually is no error there. Okay, so the projected misstatement is 10,000 plus 30,000 is 40. Those two. And are they included incremental allowance? Yeah, neither one of these are bigger than the interval. This is not any bigger than this, so this will be a yes. So this is smaller than that. It'll be included. Because there could be more things wrong. Oops. And this one's a no, just because it's not misstated at all. It's everything's fine with this one, so we would not be putting that in there. There is no misstatement on there, and even if we did put it in, it wouldn't count as anything because we're going to multiply this times something, and 0 times anything would be 0. So, yeah, because this is an understatement, there is no misstatement. There's some confusing arrows. So we'll stop right there. So this is our best estimate as far as what this is misstated by. It's a $6 million account. We've come up that it's off by 40,000. So that's what we're going to start out with anyways. And that's our best estimate. Here's a question for you. How many items are in the sample? Notice we have an interval of 50,000. The book value is 6 million. So how many items are in the sample?
$120.
Yep. Yeah, so there's each interval 50,000. So if you divide 6 million by 50,000, that'll tell you how many items there is. So there's 120. They came up with 3 problems. Actually, there's only 2 problems here, really, out of it. And this is one of those reasons why you use this method, is that out of 120 items, only 2 of them are misstated, or as we call them, that they have overstatements. And if there's few, it probably reduces the sample size quite a bit. So instead of 120, if you're doing classical sampling, maybe instead of 120 items, maybe you have to take 200. Huge amount of work. So this method, if there's not too many errors, this method will save a lot of work. Yeah. So okay, let's stop there. And nothing to turn in this week because we're not done with this. We'll finish this next week. And will we finish this next week? I think so. We'll probably finish both of these next week. All right. Well, so yeah, so that'll be it for tonight. So next week we'll finish up the monetary unit sampling. There's still one more type of sampling we're going to do, which we'll get. That we won't get to next week, obviously, but later on, and then we'll have the sampling exam after that. So we got two of the next week. We'll have two of the sampling handouts down, and one more to go, and then we can have the test on that too. Any questions on anything?
No.
Okay.
No.
All right, well, so nothing to turn in. Next week, I'm gonna get down your name so that we can credit for it. And yeah, so nothing to turn in, and then next week we should finish everything up. Okay, have a good evening.
Great. Thank you so much.
Bye, have a good night.
Yes.
Good night.